Hi, I'm Andrew Martin, one of the portfolio managers for the Australian equity team here at Alphinity. In this month's update, I thought I'd briefly touch on the recent reporting season and, of course, the topic of the year in Australia, the major banks. I do go into these topics in a lot more detail on the recent Finding Alpha podcast, which you can find on our LinkedIn page as well. So, reporting season. Look, the most recent reporting season in August was largely in line with expectations at a reported level, but still ended up with low single-digit downgrades for earnings consensus looking forward, which is ultimately more important. And that was because outlook statements from companies were much more cautious than expected, and that was broadly across sectors. So while things are resilient in the economy to a point, clearly they have been slowing, and clearly there's a concern that they will slow further. We really only saw small upgrades in banks, diversified financials, and tech to some degree. Pretty much everything else saw downgrades, and in most cases, sort of accelerating downgrades through the year, with resources and commodities in particular seeing even more downgrades than what we've seen more recently. So what did we learn from reporting season? I think we learned that the consumer is actually pretty mixed. We keep hearing about the resilient consumer, and to an extent they are in aggregate, but there are parts of the consumer that are quite soft and softening in many areas. We're certainly seeing that through an accelerating trend of down trading, for example, in many sectors, home brands in supermarkets, for example. The companies that are doing relatively well in that sector are those that are able to better manage their costs. We certainly saw anything that was housing related be quite weak. I think margins overall through most sectors remain under pressure, even as revenues hold up pretty well, because we're seeing those higher costs being persistent through their P&L, through higher wages still coming through, higher lease costs coming through, the roll through of higher tech costs, and because of that, there's a lot more talk from the companies about how they're going to go tackle those higher costs rather than just relying on pushing price through as they have the last few years. So you'd question whether or not that in itself is a catalyst to see sort of an uptick in unemployment going forward. From an AI perspective, we're not really seeing many companies pointing out where they are actually seeing the benefit yet. A lot of talk about it, a lot of talk about what they're doing and how it will help, but not really coming through to offset those costs just yet. Many New Zealand-based businesses in reporting season have continued to be under pressure, given that economy itself is very weak. And then we saw in the banks that credit quality continues to hold up pretty well for the banks. Low bad debts, for example. Now that said, we are off a very low base, seeing a small deterioration starting to come through now in both individuals and companies being falling behind in payments, for example. Still well below what we were pre-pandemic era, but we're just starting to see a tick up. But in general, as unemployment remains low, the losses for banks remain low and are likely to stay that way for some time. Which brings us to the banks. Probably one of the most common conversations we are having with clients is around the major banks and their continued outperformance. They've had a really strong year, both in an absolute share price sense and relative to the market. That's despite them producing flat to negative actual earnings growth in that period, which is unusual, and that makes valuations really stretched. If you look at absolute valuation measures like price to earnings ratios or dividend yields or price to book, all of them are at multi-decade highs at the very least, and just really hard to justify in pure fundamentals. However, where banks do appear more interesting is in a relative valuation sense. So for example, if you compare the price to earnings ratio for the banks to the price to earnings ratio for industrials ex financials, just given the market is actually quite expensive overall, on a relative basis, banks, while they do look a little bit expensive, they're not anywhere near the extremes that we see on the absolute measures. So that in itself is giving them a bit of support that in a relative sense, their valuation measures look okay, if not a little bit expensive. But then you add on the fact that, as I mentioned before, they're just one of the very few sectors actually getting earnings upgrades, maybe slightly low quality earnings upgrades from provision release, for example, but still standing out relative to the rest of the market, which is in downgrade mode. Again, becomes a little bit more rational as to why the banks are doing well when you start to consider that they're one of the few that are actually getting better earnings outcomes, not worse earnings outcomes as the rest of the market is seeing. Now, there is a few technical factors as well. Banks do have a lot of buybacks going on in the market. That soaks up some liquidity. There's definitely been increased passive buying over the last few years, but that's an ongoing thing, not something more recent. And we are seeing some buying this year from the super funds to help offset their bank underweights that they've otherwise had elsewhere in the portfolio. So you add all that together and you can see why there might be a little bit of support for the bank in a relative sense. Now, valuation itself is very rarely a cause for material underperformance by itself, but it certainly does exacerbate things if you finally come up with a negative catalyst. Now, what could that negative catalyst be? Would likely need to be an earnings issue for the banks. Again, hard to see at the moment. And that earnings issue would probably have to come around bad debts, for example. So if the economy erodes further, more people miss their payments, that would be a surprise to the market. But banks are very well provided for here, so it would have to be a reasonably material deterioration, I would have thought, and it doesn't feel like that in the near term. Otherwise, and probably more likely, it needs to be sparked by interest in other sectors. So typically, we see flows between banks and commodities, and commodity prices more recently have been under pressure with a weak China and a stagnant global economy, again, adding to why banks have looked relatively good. But if we saw any change to that, or any change in sentiment towards those sectors, we saw some earnings revisions up in those sectors, that would probably spark some flows out of the banks and into other sectors. Now, hardly a convincing argument at the moment, just given the downgrades we continue to see in commodities and where commodity prices are now, likely more downgrades. So for us, look, we've been a little underweight the banks for most of the year, given the valuation stretch. But given we're seeing the upgrades, given that in a relative sense valuations haven't been that stretched, and the lack of alternatives to hold in the market, we've been a little bit closer to the benchmark than you may expect given the valuation stretch. Now, that being said, more lately as the banks have really pushed on again during and post reporting season, the extremes of those absolute valuations are at a point now where we have taken a bit more out of the banks and really trying to concentrate our exposures into the relatively cheaper banks, something like a Westpac, for example. So while we are underweight, and we are more underweight than we were earlier in the year, we're still dancing relatively close to the door, as they say, and awaiting a firmer catalyst before becoming more negative on the sector. But it is becoming harder and harder to justify with those valuations. So thank you for your time, and we will be back next month with another update. Thank you.